Hey everyone, today I want to talk about the real estate market cycle. So all markets are typically defined by highs and lows, or like the stock market, booms and busts. Real estate, unlike stocks, are less liquid, so it takes more time to cash out of real estate versus stocks. So therefore you see the highs and lows aren't as pronounced, and the time between each phase typically takes a bit longer. In real estate, the cycles are defined by a boom, a slump, and a recovery. And today I want to talk about what happens in each of those phases and the best real estate investment tactic you can employ in each of those phases. So let's start from the bottom, which means the end of the slump, beginning of the recovery phase. So at this point, house prices have dropped, but you're starting to see them stabilize and slowly creep up again, which means it's a good time to start looking into buy and hold investment properties or your typical rentals. The reason for this is because you're getting in at a good price, and assuming it cash flows, which it should, you'll be able to ride the market through the recovery and boom phase and see that appreciation, which could take years. So next is the recovery phase. At this point, you see house prices steadily increasing, sales are improving, and we're seeing a more balanced market. Now is a good time to start looking into rent-to-owns, or otherwise known as lease options. The reason for this is you want to be able to justify, as an investor, the higher sale price at the end to the tenant buyer. And you can't really do that unless you know the prices are steadily increasing, or you get the houses at a great discount. Either way, it just improves the chances of you being able to sell your house at the price that you want. And because house prices are fixed at the beginning of the rent-to-own contract or lease option contract, there's a good chance that the tenant buyer can walk away with a bit of equity in their pocket as well if prices are increasing sufficiently enough, which makes it a win-win for both parties. So next we're moving into the end of the recovery, beginning of the boom phase. So at this point we're typically seeing rapidly increasing house prices, and we're moving more into a seller's market. Vancouver and Toronto are actually very good examples of this. They've been in a boom phase for the last decade. So at this point, it's a good time to look into doing fix and flips, just because fix and flip projects are typically shorter term and allows you to get in and out before the market gets too hot. Lastly, we move into the boom phase. So at this point, investors want to be a little bit cautious, just because we're starting to see house prices increase to a point where it might be a little bit unsustainable for the market. So you'll see decreasing demand, higher supply, which then could lead to a correction in the market, which will then move us into the slump phase, where prices will start to drop and we'll see more of a buyer's market at that point. But a lot of projects like rent-to-owns, fix and flips, you might not be able to see that appreciation when we're too close to the top of the boom. So those might be a bit risky. Same with buy and holds. You also might end up seeing loss in equity if the prices drop, which might put you underwater if your mortgage is more than the value of the house. So just be a little bit cautious. Not to say there aren't deals in this time, you just need to know where to look. So there's one caveat with respect to this market cycle analysis, and that is it's all a little bit retrospective. What I mean is, until you start seeing prices decrease, you wouldn't recognize that you just hit a peak. And until you start seeing prices increasing, you don't realize that that was the trough or the valley. So there's always a little bit of looking back, unfortunately. However, by knowing the market cycle and recognizing these signs allows you to plan a little bit ahead in terms of what your next steps will be. And really, as long as there's a sufficient margin of safety, so as long as there's enough of a gap between what you buy for and what you can sell it for, or as long as there's enough of a cash flow gap to absorb any losses, you can still make money no matter what market cycle you're in. So I hope you guys enjoyed that video. If you guys like what you're seeing, please subscribe. Really appreciate it. And until next time, happy investing.